Well, hello folks, it's T. Brian Hayes here from Hayes Advisor Group with your April 2016 Educational, Economic, and Market Review. In this video, we'll talk about some of the economic events that influenced markets last month and give you some insight into what they might mean for you as an investor. As always, please stay tuned at the end for required disclosure statement. Well, the Federal Reserve Open Market Committee met in late April and, unsurprisingly, decided to leave interest rates where they are. Though the Fed still expects to raise rates this year, central bankers clearly intend to move carefully. Though the Federal Reserve seems ready to raise interest rates as soon as economic growth picks up, the latest economic data doesn't support their narrative. Before the meeting, many investors were expecting a June rate hike. However, the Fed's cautious tone and the November election make it more likely that the next rate hike won't come until December. Investors also got to look at fresh economic growth numbers. The advanced estimate of first quarter gross domestic product showed that the economic growth stumbled, increasing just 0.5% in the first 3 months of the year. That's a sharp decrease from the 1.4% the economy grew in the last quarter of 2015. The weak growth is concerning, but it's not something economists are panicking over. Slower spending by consumers and governments, as well as cutbacks to businesses investing stemming from the plunging crude oil prices, all contributed to the dismal growth for the last quarter. The good news is that some economists don't expect the weakness to stay with us for the rest of 2016. Though past performance can't predict the future, weak first quarters were followed by stronger quarters in several of the last few years. First quarter earnings season kicked off in April, and the low expectations investors had about performance paid off because they left room for positive surprises. Out of 209 S&P 500 companies reporting so far, earnings were down just 5.5% from the first quarter of 2015, and revenues were down 1.6%. So to sum it all up, though the economy continues to chug along, growth was hard to come by for U.S. firms in the first quarter, but many challenges still exist. Slow economic growth also complicates things for the Federal Reserve, and as we said earlier, we're not likely to see a rate increase anytime soon. However, it looks like we have some brighter growth ahead of us in the second quarter. We'll know more in the weeks ahead. Now let's turn our attention to the markets for April. Volatility continued to decrease in April, and most indexes fared pretty well. However, risk remains high, and many indicators still have us in a transitional bearish market environment. If you look at the market since the beginning of the year, it has been a wild roller coaster ride. Again, the goal during these wild swings is to stabilize your portfolio, and that is what many of the active managers have done so far for the year. Still, many of your monthly reports didn't look too well for April. But, these types of rallies are going to occur in bearish market environments. Again, if you can avoid these wild and steep swings, your portfolio will grow well via compound interest over time. As always, don't let short-term market swings cloud your judgment for long-term investment objectives. The current rally could still just be a kickback rally in a bear market before markets head down again. Until we see these indicators start changing to more lower risk, continue to hedge your equity positions. Once again, it's T. Brian Hayes here with your April 2016 review. Please remember here, nothing we talk about is a recommendation. If you'd like to discuss your personal financial situation, as always, feel free to give us a call at 1-800-939-1603. As always, we'd be happy to talk to you. I look forward to talking with you soon. Enjoy the month of May.